Real estate stocks are the third best performing sector this year, with a 33% return through October. Only energy stocks and financials have beaten REITs for that higher return. But that overall return hides some big differences in property types. The National Association of REITs tracks 154 real estate investment trusts across 12 major property types and shows returns were as high as 56% through the first 9 months of the year, but also as low as 7% for some types of real estate. Real estate can still make you money, but getting those higher returns means understanding the trends and knowing which property types will outperform, as well as the ones that will lose your money. That was true this year, and it will be true for 2022. In this video, I'll show you the factors affecting real estate stocks and REITs in 2022, the property types to watch, and one to avoid. Then I'll reveal 5 REITs to buy for outsized returns next year. Here, you know we can't get started though without that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, if you're investing in real estate next year, you need to be watching 3 market forces because these are going to drive the returns for the year along with which property types will benefit. And by far, the biggest driver of returns, not just in real estate but across stocks, is going to be inflation. Consumer prices have jumped by more than 6% over the past year, the highest rate of inflation in 30 years. Home prices have increased by 20%, another multi-year record. Of course, the Fed is still playing naive to the problem. Chair Powell and the central bank is grasping to that idea that increasing prices are only going to be temporary, that we're going from historic levels of inflation back down to nothing in a matter of months. And yeah, not gonna happen. Now, inflation is going to affect real estate in a few different ways you want to watch for. Now, first is just that upward driver for property prices as protection against inflation. Every investor needs to have some real estate exposure in their portfolio. Also though, and this is how it affects property types and REITs differently, is how well those property owners are going to be able to increase their rents. For example, against the year-long moratorium on rents, residential landlords couldn't increase rents for fear of not getting paid at all. In fact, the owner's equivalence rents, a measure of rent prices across the U.S., increased just 2.5% over the year to January, while home prices increased by 20% over that same period. So here, you need to watch for property types with shorter average lease agreements. Now that means landlords are going to be able to increase those rents faster along with inflation, instead of being locked into those contracts for years. The worker shortage and coming higher wages is also going to be a big driver, especially for retail and certain residential property types. There are now more than 10 million job openings for just 7 million unemployed looking for those jobs. More than 4 million Americans quit their job in August, a record high, and the Great Resignation is going to be a major theme throughout the year. Now, of course, this is going to increase wages as employers fight for those workers, especially at the lower end of the income scale. That increase of $2 an hour is a lot more for someone making $12 an hour than it is for someone making 50 grand a year. We'll look at some specific property types and real estate stocks for this next, but look for retailers and manufactured homeowners to benefit big time. Now, finally here, before I reveal those 5 real estate stocks to watch, consumer spending could surge in 2022 and take a handful of stocks with it. JP Morgan estimates that households saved up as much as $1.7 trillion over the last 18 months, with the average savings balance up more than $2,000 to over $6,000, locked down collecting those stimulus checks but not spending it. That money could now come through in a wave of spending that benefits retailers, shopping malls, and the hotel segment property market. Now, besides the individual real estate stocks that we'll look at next, I also like to diversify my property investments with a fund like the ones available on Fundrise. I've been investing on the platform since 2019 and earn a dividend yield around 5% and appreciation of 6% a year. Fundrise makes it easy to invest in a managed portfolio of real estate, all in one fund and a low annual expense similar to ETFs. I can always click through to see the details on every project in the portfolio, but to tell you the truth, it is so stress-free that I go months without checking. I know Fundrise is managing the properties, and I'm earning a solid return with no work or analysis. Use the link I'll leave in the description below to try Fundrise risk-free for 90 days. This first group of real estate stocks I'll highlight, healthcare, has lagged the rest of the market for 2 years as hospitals cut those higher margin services to serve COVID patients, but that's set to reverse in 2022. Our first real estate stock here is one I've been following for a while, Medical Properties Trust, ticker MPW, and it doesn't get that much bigger than healthcare properties. MPW is the second largest owner of hospitals in the world, with 442 properties and rare international exposure for a REIT, operating in 34 US states and 9 countries. And I really like the company's business model here. It buys properties owned by those healthcare providers, then leases it back to them on 20-year terms for triple net payment. That frees the healthcare provider to do what they do best, providing that service, and then MPW takes care of the property and has a long-term tenant. Plus, that triple net lease means the tenant pays all property costs. MPW just sits back and collects the checks, so operational costs are extremely low. 99% of the properties here have a built-in rent escalator based on inflation, so the company is covered on that front. Shares pay a 5.3% dividend yield, the highest of the 5 stocks that we'll cover, and trade for just 12.2 times FFO. Now remember, that price to FFO, or funds from operations, is important here for real estate stocks. Because these companies take an enormous amount of depreciation off their income for tax purposes, earnings aren't a good measure of cash flow. That means you can't use that price to earnings ratio like you do with other stocks. Instead, funds from operations is a better measure because it adjusts those earnings for that non-cash expense typical of real estate companies. FFO shows the true cash generating power of the properties and is a critical measure of how expensive these stocks are, as well as the safety of that dividend. Here's the calculation for the hardcore among you, but any REIT is going to show you this in their financial statements. Another real estate stock to watch here, CareTrust REIT, ticker CTRE, owns 223 properties managed by 23 operators across senior housing and acute care. Nation, baby boomers started turning 80 last year, and with the average age of admittance into nursing homes at 79 years old, that means CareTrust is going to be right in that sweet spot for demand for more than a decade. And COVID hit this sector as hard as any, pushing occupancy down from 78% to just 67% last January, but it started to recover and occupancy was back up to 69% as of April. The company has the lowest debt to EBITDA ratio among 15 competitors at just 3.2 times, so plenty of flexibility here to push through that recovery. Our shares pay a 5.1% dividend yield with a 9.3% annualized increase over the last 5 years, even during that COVID weakness. The stock trades for 14.4 times FFO, so a little more expensive here, but FFO is expected to grow by 7% this year. Real estate stocks in the residential space could have another great year as rents rise faster, catching up with that surge in home prices. Our first residential play is Apartment Income REIT, ticker AIRC, a smaller company with 99 upscale communities in 12 states and DC, focused in the largest metro areas. The higher rents collected on higher income properties, the larger cities, as well as a great management team, makes this one of the most efficient REITs out there with a 72% margin on its net operating income. Now that's industry leading for more than 17 quarters. The company reported average rents have rebounded to pre-COVID peaks by the first quarter, and shares pay a 3.3% yield. Now that profitability means shares are a little more expensive here at 24.5 times FFO, but those funds are expected to grow by 12% next year. This next real estate stock, UMH Properties, ticker UMH, is a unique one in the residential space. UMH owns 127 manufactured home communities with approximately 24,000 developed home sites in 10 states. It also owns over 1,800 acres for development and a potential 7,300 more lots. UMH stands to really benefit from the strong jobs market and the wage increases over the next year. Collections are already up to 95% of July rent with 86% occupancy, so it's largely already moved on from that COVID impact on the business. Shares pay a 3.1% dividend and trade for 24.1 times funds from operations, but this one has seen that strong growth with the FFO up more than 40% last year. And I'm making a contrarian call here on office space for 2022. That returns could surprise higher. And nobody expects office space to come back, but companies still want people back in the office. Even on a shift to some remote work, office demand could still be stronger than expected next year. Boston Properties, ticker BXP, is one of the larger office REIT stocks with 196 properties and 51.6 million square feet, including 4.3 million square feet of leasable space under development. And beyond that potential recovery in office space, BXP has a growth segment in its life sciences properties, adding diversification and growth to the portfolio. Shares pay a 3.4% dividend yield with a 7.7% annualized growth over the last 5 years and trade for a relatively low 16.5 times on that price to FFO basis. Now those are the 3 property types and the real estate stocks that I'm watching for 2022, but just as important are which to avoid. I found one property type with shaky foundations that could be ready to collapse. The self-storage property type has been the top performing this year with a 39% return in just 9 months, and it hasn't just been this year. The major REIT stocks in the space have jumped since early last year with Extra Space Storage, ticker EXR, up 87%, and Public Storage, ticker PSA, up 57%. And those returns have been great, but the stocks are now terrifically expensive. Shares of EXR now trade for 29 times on that funds from operations basis. The stock has run so fast that the dividend just can't keep up and now pays just 2.5% yield. Nation, real estate as an investment is extremely cyclical, and it just feels like self-storage has peaked out here. Look to those other property types and the real estate stocks to rise on those other fundamentals and protect your portfolio in 2022. Don't forget to get your free trial on Fundrise with the link below, or click on the video to the right for the 5 best investments you can make in 2022. 5 investment ideas that you don't want to miss. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.